Hello everyone! So today we've got news that Fed actually cut their purchase of T-bills from commercial banks from 40 billion a month to 25 billion a month, which is expected to cut down the inflation. But what does it even mean and how it actually works? Let me explain. So currently, we are in a phase of so-called soft QE, when Fed injecting liquidity, money supply, since December last year by 40 billion a month. As of today, they have decided that 40 billion is a little bit too much, especially given the read on inflation that we're getting and overall general concern. But let me explain how it actually works right now on the other side of a story and what commercial banks are doing with this excessive liquidity distributed by Fed. So the narrative again is we need to cut spending. We have right now officially nearly 40 trillion of national debt. Think of it this way. The inflation problem was there 3 months ago, year ago, and definitely it has still been there December last year. And 40 billion of monthly T-bills repurchases by Fed is equaling to 0.2% of American economy, which if you will multiply by 12 months and do a simple math, will actually land you on inflation rate or money supply expansion rate substantially higher than 2%. And that is taking into consideration that inflation rate was not zero to begin with. But in a world of commercial banking, things are going a little bit further. So let's assume you get an IOU from Federal Reserve. As a commercial bank, in the case that liquidity does not get injected to the market, meaning not lend to retail customers, as a commercial bank, what you can do, you can park overnight that excess liquidity back with the Federal Reserve for a rate at 4.3% overnight and get that liquidity back the very next morning plus interest. Now it's better that you try to not remember what the regular deposits are paying, as I would believe that would be somewhere between 0.5% and 1% in case you're lucky, or possibly 1.5%. But also what it does, it creates extra liquidity on already extra liquidity, which effectively then creates more inflation. And all this is happening every single day with increased by month money supply only from QE itself. On the other hand, most of retail workers, they have salary revisions once a year, while commercial banks are printing money out of thin air together with Fed 24/7. In addition to the fact that every single time a borrower comes to commercial bank and asks for a loan, where do you think those money are coming from? They're lent into existence. They've never existed before. This is not money from deposits of other participating members in that particular bank. And the underwriting asset of that loan is essentially whatever it is that you needed the loan for to begin with. Might be a house, might be a business. Business is actually a way better idea than a house. And it also brings me to the point where a lot of retail customers, they believe that real estate is a great asset to have, which to an extent it is, but if you are referring to real estate as the house that you live in, if you will try to calculate inflation rate over the period of time that you have owned that house, you will quickly realize that the level of price appreciation you have got is vastly correlated with the level of inflation in those years. And that's before you would exclude your maintenance cost and the interest cost. Do whatever you will with this information, but personally, if I would be you, I would not be parking my money at 1% at the bank.